Hello guys, welcome to my channel. Today we are going to take a look at a Singapore listed industrial REIT called Aims Apac Reit. Now we are here at its website. Wow, actually the website looks quite pretty. Well, let's go and take a look at what it says about itself first of all. Welcome to Aims Apac Reit. It states that it is a growing industrial REIT listed on the main board of Singapore Exchange since 2007, and it is to deliver a stable distribution, long-term growth to the unit holders. Okay, so this is what every REIT will tell us. Now, over here it says that it has a total of 26 properties in Singapore and 2 in Australia that is worth a total of 1.8 billion Sing dollars. Okay, seems like a reasonable size, mid-size industrial REIT in Singapore. Then let's go and take a look at its portfolio. Okay, on first glance, the properties are pretty well spread out at all corners of Singapore. It pretty much covers, I think, all those areas that you can, have people stay and do the industrial activities. But what does the green, orange, red represent here? Hiya, there's no legend over here to tell us what it is. So I think I got to. Oh, okay, now I see. So this red color represents logistic and warehouse, and I got to click one by one to see the rest, I think. So light blue means light industrial. There is one dark blue business park here, and one brown in high tech in somewhere in Woodlands region, and a lot of green called industrial, general industrial. Okay, I think this one something can be done for the web designer. So these are the properties in Singapore. Let's go and check it out for Australia. So as it stated, right, it has a total of 2 properties in Australia. So the first one here is in Sydney. So same thing again. I don't know what does it mean in Sydney. So I think I need to click this. So it seems like Sydney is a business park, and the one in Brisbane, Queensland, is a light industrial property. Okay. So if I scroll down, it does tell us a little bit more about the properties, but I'm not going to click onto this. I'm going to jump right into the investor relations to check out some of their publications. Right, let's see. Publications. Okay. So here we are. It has its annual report of 2021, which was listed in, on 7 July. I think this is the latest annual report that we have for now. But I'm going to take a look just at its the latest quarter result. Okay, so this is the first quarter result of 2022. I'm going to click onto it. Let's take a look at its latest financial results. As I scroll down, I'm just going to say off some of my opinions of this particular REIT, and let's learn together. Okay, so the highlights of 2022 first quarter. Growing DPU. Okay, so for all those who are not that familiar with DPU, it basically means dividend per unit. It means as a shareholder, or in this case we call them unit holder, it is how much they are entitled for every unit they have. So in this case, they're saying that DPU of 2.25 Singapore cents per unit. And the remark says that it is a 12.5% year-on-year improvement from last year. I think it's reasonable since we know last year it was during this height of COVID-19 pandemic, and all the companies are generally more cautious about the cash flow and all this. So okay, so this is a great improvement, 12.5% improvement, and it states this the reason over here is because of the newly acquired property in Singapore and higher renters. So even during this pandemic time, they're able to go for a higher rent at 2 other properties. Good job. Okay, and I think it is reflected in its gross revenue here. It is 16.8% higher than last year, and because of that, the net property income is 23.9% higher. But as you can see, right, for those people who learn some sort of finance, you can see that if the gross revenue has increased by 16.8%, yet the NPI, the net property income, has increased by 23.9%, it basically means that the management has managed to control its cost pretty well. So the revenue increase does not immediately translate to the cost increase in tandem, right? That's why the net property income has increased at a higher percentage. And over here, the property has also done certain renewal leases, new leases, right? And its overall portfolio occupancy is close to 96%. So let's check if it is higher or lower than the average. So as the management states here, right, it says it is well above the JTC. So for those non-Singapore viewers, JTC means Jurong Town Corporation. So basically, it's like a regulator of the industrial properties in Singapore. So according to this publication, Singapore average occupancy for industrial property is 90.1. Wow, so it basically means that this particular REIT has managed pretty well. It's above the industrial occupancy. And let's continue. It says establish resilient portfolio, more than 50% under warehouse and logistics. Okay. So we know that because of this new e-commerce trend that is sparked off by this, all these Shopee platform, Amazon, and nowadays we also have this COVID-19. Seems like e-commerce has a long runway ahead for us. And the company also states that it has a healthy leverage of 34.3%. Now, for those of you who are not too familiar with leverage, it basically means how much they borrow. So in this case, for every, you can simplify this to say that for every $100 worth of property, they only borrow $34.3, right? So the rest is actually fully paid up by the equities, by the shareholders' money. And it has a low blended funding cost of 2.8%. So that's like a percentage they need to pay the interest percent, and healthy interest coverage ratio, so 4.3 times. So what is ICR, interest coverage ratio? It basically means how much the earn is able to, how many times they have is able to cover the interest expense. So okay. Here it says what is the spread between this company return as well as the risk-free return in Singapore context. Right, so this is the Singapore government 10-year bond. So based on this, it says it has 1.58%, and the company is able to return us 5.81%. So I guess this is representing, in finance term, the risk premium for this particular firm. And it shows us this slide of the total distribution since 2011. So for the past 10 years, we can see that the light blue means the total distributions. So it's not a pretty picture. So it has grown continuously from 2001 to 2016, but I think ever since then it has been fluctuating ups and downs. As for the distribution per unit, as we have seen, DPU, it has been at a very consistent basis around 9 cents to about 10, 11 cents. But last year was hit by this pandemic, right? So it drops below 9 cents. So let's see for this particular quarter, how is it like? So this is basically the information of how much they're going to pay off, 2.25 cents for this particular quarter. And these are some of the results as we have already seen, right? So um, let's continue to see some of the balance sheets. So we can see the total assets over here, which comprises of the properties that we have seen previously, some of their joint ventures, so on and so forth. And they go and count the total liabilities, net off. They have the net assets over here, which is a combination of the equity of the unit holders as well as some of the perpetual securities. So with that, they can derive the net asset value of each of the units, which is currently at $1.35 Singapore dollars. So with that, they derive the aggregate leverage at 34.3%, as we have seen previously. So all this seems pretty reasonable, and let's continue to look through. So over here, on the day when it publishes this result, the share price was at $1.55. So it does show a premium over the NAV. So it means that for those shareholders the new shareholders who are buying in at the current share price, they are buying at a premium of what is the underlying asset value of this particular company, right? But of course, the expectations of the forward quarters are different for each of these investors. Some of them might be very optimistic on the forward-looking statements and they're willing to pay a premium for this particular company. So this finance part, well, I'll leave it out for the individual investors, but we just state of what is the obvious here. And let's continue down. So, well, I see this new term, weighted average debt maturity. So over here it says 2.0 and 3.3 post refinancing on a pro forma basis. So, well, what does it mean? So, what does it mean is that it means the company has a debt maturity that is going to come upon them, right, on average in 2 years' time. But because they're going to do some form of refinancing, so it will be able to drag it out for 3 years, 3.3 years. So some of the debt facilities that they have stated over here, let's take a look if they have a better graph. Okay, so here they give us some sort of a diagram. So they're going to show us that this 120 million, right, which represents, I guess it means this, right, 4 year Sing dollars revolving credit facility is being pushed to mature in 2026. I think this is the refinancing that it has mentioned previously. And this 50 million here, 50 million over here has also been shifted. Has also been shifted to this 2026. And meanwhile, some of these maturing in 2023 it has been pushed to 2027. So I think the management is trying to do some form of refinancing to ensure that some of the debt that is coming due very soon will be pushed further right into the further years. Okay, so we have already seen this revenue performance previously. So key portfolio statistics. Okay, so I stated 28 properties, so on and so forth. So it does show like the total number of tenants has dropped by a total of 5 tenants, but the average portfolio occupancy has upped marginally to 95.7%. And okay, so over here we are seeing new terms again. Weighted average lease expiry. So let's see what it means. It says computation included forward committed leases, right, so on and so forth. Okay, so for those of you who are not too familiar with this will represents the on average, right, how many more years does it have for the lease to expire. So if it states here 3.98 years, that means that on average their lease will expire on 3.98 years if they're not doing anything to renew the leases. And over here it has this weighted average land lease expiry. Now for this, it is a very, very common thing for those properties that are bought in Singapore, because Singapore industrial properties are either on a leasehold of 30 years or 60 years. So they're not on freehold basis. So upon the maturing of say 30 or 60 years, the land has to be returned to the government, right? And the value will go to potentially zero. So we have to check it out and see how long more does it have before the land lease will go to zero. Of course, there are many ways that the management can do certain things to improve this, right? Say to renegotiate with the authority to lengthen this land lease or to top up the premium difference, right? So on and so forth. But here we can see that given the management is not doing anything, right, this weighted average land lease will only continue to decrease and decrease. So okay, so we can see that it is majority still in Singapore at about 93% and 7% in Australia, and it is being reflected in the rental income, so on and so forth. And as stated previously also that it has 50% in the logistic and warehouse, and we can see that it has also business park, light industrial, so on and so forth. So master leases is at 35.3%. So what is master lease? Master lease basically means that the entire property is leased to one user, and the user will use the entire property, right? So only one tenant. For those multi-tenanted, it basically means that the property will be subdivided, sublet into different portions, so that smaller users can actually use the property. and it shows us some of their tenant base, right? Some of the spread, where they're coming from, and so on and so forth. Seems pretty well diversified in this case. And active lease management, I think previously the company has mentioned also, like some of the new and renewal lease that they are trying to do. And over here we can see that for the leases, it is going to spread out for many years to come. So it seems like on average, um, around 20% of leases will be expiring for the next 3 years. Of course, the company has also stated just now that the weighted average lease of expiry is around 3.98 years. So this is quite reasonable, as we can see over here. So here, this slide, they just try to show us who are the top 10 tenants. So Optus, for those Australian viewers, you will know that Optus is actually one of your major main telecommunication companies, right? And for Singapore viewers, you will know that Optus is actually owned by Singtel. And Illumina is one of the most biggest bio firm in the world, and KWE, Bionics, and so on and so forth. So some of these are pretty big names, and it says that 7 out of 10 of their top 10 tenants from the life sciences, logistics, data centers, so on and so forth. And this one we have also mentioned just now, basically how long more does it have for the land to expire. So you can see that, right, 12.7% between 15 to 20 years. So something to take note here for those of you who are more cautious on this kind of land going to be expired soon. But you can see that majority of them are still beyond 20 years to go. Right, so it's a bit hard to verify, but it says that it is one of the longest among its peers by valuation. Right, so but as to where does the data come from, I guess we can verify from here, right? So again, they're showing us the occupancy against this GTC average. So you can see that for every single categories, it is performing much better. So the dark blue represents these REITs, and then the light blue represents the industry average. So over here, I think every category is pretty well, right? At around 95% and above, except for business park. And it seems like this is in trend with this industry average. So something could have happened to this business park sector in Singapore. Could be that there is oversupply, or maybe due to this current restructuring and so on. So um, we will see whether it will improve in the coming quarters. So the management also gave out some of the outlook and strategies. So macro strategies, right, like they're going to say about what Singapore economy, industrial, and looking ahead, what is it going to be, and some of their strategies, right? They're going to do some sort of more investments, active leasing, prudent capital, and partnership for growth. I think these are some of the pretty standard replies that we can expect, and some of the further redevelopment opportunities. So over here, this is something interesting with this REIT. It is saying that a large proportion of its current portfolio has underutilized plot ratios. So it means that there are a lot more areas to be tapped on. That means on the existing property, perhaps they can do some sort of asset enhancement, right, to grow the area so that they can improve the rent. So over here, they're saying that potential untapped gross area of 502,000 square feet. Okay, so I think this is pretty substantial over here. And again, they're trying to re-emphasize on how good they are, which has already been stated, and some of the environment, social, and governance, which is, I think, one of the mandate by the Singapore Exchange nowadays for companies to list it out. Some of their key accolades. Okay, again, they're just trying to pat themselves right against the back, and that's all. Okay, thank you for watching.